Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. And this is a special one, but sometimes we have interviews with guests, Ramsey, that beg for a part two, and this certainly was the case from an interview we did about a month and a half ago. Do you want to set it up?
Sure. So we had Jason Fichtner on about a month and a half ago, and we talked about just a number of amazing subjects, including Social Security, and we just got started talking about mortgages and decision sets around mortgages, and today we're going to continue that conversation where we left off. So just to reintroduce Jason, he is the Vice President, Chief Economist at the Bipartisan Policy Center, and he's a Senior Fellow for the Alliance for Lifetime Income. So he and the Alliance have been great friends of the show, and we're just happy to have them back. So Jason, welcome back. And just first of all, for people that are new in the audience, or for people that are coming back, just remind us again that the things that the work that you're doing for the Alliance and for the Bipartisan Policy Center, and let's get right into it on mortgages.
Awesome. Well, thank you both for having me back. It's good to see you again, and looking forward to the conversation. So my responsibilities and roles, my fun job, if you will, is to help people have a financially secure retirement. That's kind of my mission in life, and I get to do that both at the Bipartisan Policy Center and at the Alliance for Lifetime Income. And it's talking about protected income. It's an understanding of how to help people be more secure in retirement when thinking about protected income. And that does not just mean annuities, which we talked about last time. It's also Social Security, which is a form of protected income. And it's helping people understand what the role of Social Security and other protected income means for having a financially secure retirement, one in which they can spend and enjoy retirement, and one in which they can mitigate risks. And too often we've been brought up on this culture of you need to save, which I'm very in favor of. You need to maximize your return, which I'm also in favor of, but we don't often talk about what the risks are. And we help people save for retirement through our 401k plans, our 403bs and IRAs. We have employer-sponsored plans. We have a lot of tax advantages. People get to retirement, we say, have a nice day. And they're looking around for help, and what do they do now with these defined contribution assets they built up? They're afraid of spending them down and running out of money in retirement. How do we help them psychologically and financially make sure they can draw down that income appropriately, whether it's through protected income strategies like annuities, whether it's drawdown strategies, whether it's thinking about debt and what to do with debt levels, because debt's very important both from a financial standpoint and a psychological level. How do we help them have the best retirement? And we can do that with the Funding Our Future campaign we have at the Bipartisan Policy Center and the Alliance for Lifetime Income and the research we're doing at the Retirement Income Institute. And we had a great discussion last time. For the new audience members who didn't listen, please pull up the episode about a month and a half ago. And we left it off. We ran out of time, but we were talking about whether or not people should pay off their mortgage in retirement. And I had mentioned some previous research I had done that showed that with each successive generation, less people are paying off their mortgage before they enter retirement. And what does that mean? You have some financial professionals telling you, of course, interest rates are low. You shouldn't pay it off. Invest that money someplace else. Others are saying you want a less risky retirement, pay off your house and use that investment and that cash for something else. What do? And that's where we left it, and we're hoping to tee it off again today.
Yeah, well, and I guess for most people, right, if you said what are the biggest assets in retirement, it would be, number one, probably Social Security. Probably number two would be any equity you have in your house, and maybe if you're lucky, you've got a 401k. Jason, is that the kind of the right way to think about it?
Yeah, to think about when you think about an asset in retirement. So the beauty of Social Security is it pays your stream of income, but it's not giving you a lump sum. So you can't go to Social Security right now and say, "Hello, I'm 67. I would like my lifetime stream of income as a lump sum," and then you think of it as an asset. You think of it as an income stream, but you are right to talk about it as an asset. The house and your 401k you see as a lump sum, but you can convert that into an income stream. And that's where we start thinking about how do we use this kind of assets to create protected income or income streams that would help people have their most financially secure retirement. But those are the three biggest. And actually for most people, when you think about the lump sum amount, like what you actually can convert to cash today, it usually is the house that's bigger than the 401k plan for most people. That is their primary asset going into retirement. So how they utilize that asset when they do with it is very, very important for financial security in retirement.
Yeah. Now, I probably fall on the extreme when it comes to homes, and it's interesting what shapes your perspective of risk, Jason. You're smack on it. I don't think we can talk about this. My mother's a small business person, and I would say she never should have been. It was, and we frankly, growing up, it was rough. We had a couple times when our house was close to being repossessed because she got too far over her skis with work and mortgages. So there's nothing like coming home to see auction notices on your door to say, okay, this will never happen. And so I'm somebody who opted for the smaller house that was paid off. Yeah. I've always, Jason, had friends, and Ramsey, you're probably in the other, probably from a more risk, have a better view of risk. But Jason, I had friends saying, you got to be kidding me. In the real estate market, unleveraged property is an asset that's just going to waste. So how do you think about risk, especially as you're there and getting closer to retirement?
So I always found buying a house, the process, so much backwards than, say, buying a car. So if you were to go buy a car, and if buying a car in today's environment is a lot harder because of supply chain issues, so the prices are higher. But usually when you went to buy a car, the salesman would ask you, Paul, Ramsey, how much do you want to pay a month for your car? What would the best answer be?
I don't know, X $100 a month?
Well, I'd like to say zero. Right? I'd like to pay zero, but that's not the option.
Okay.
Right? So you say zero, but but some people say, well, I paid $400. So the dealer finds a way to fit you into the most expensive car for $400 by doing what? Well, they can extend the terms of a loan. So even though we're talking about housing debt, think about car debt. So my grandparents always paid cash for their car. Then you started getting loans out. So the average term for a loan used to be 3 years, then 4, then 5. Now it's 7 years.
7.
So people
for
are
a
taking
car,
out,
really?
For a car. So now people are taking out 7-year mortgages for a car, and some people don't own the car long enough. So when they go to get a new car, they're actually underwater. They owe more than the resale residual value of the car is, and the dealer's like, don't worry, you want to pay $500 a month? We'll just roll that balance into the next loan. So they keep getting further and further underwater with debt by getting new cars. So the house sort of works in the same way, but backwards. We go in and people say, look, mortgage rates are lower. Because the rates are lower now, you can afford to buy more house. So let's get a more expensive house, a bigger house, because the rates are down, we can keep your mortgage payments lower. You're like, this is a fantastic deal. All right, I'll do it. So now people have been buying bigger houses, more expensive houses with lower rates. As rates go up, that of course changes. Housing becomes more expensive, they might have to downsize. But we've created a generation of people who are used to lower interest rates and buying bigger houses. Are they going to be underwater? Are they going to pay them off? Are they going to keep using revolving credit? This is the problem with risk. And again, we might be more comfortable with debt now, where we take out debt for a lot of things. And I now see online when I go to Amazon, it says, do you want to pay this in 4 quarterly installments? And I'm like, no, I don't. But I still put it on a credit card. And it's a much different psychological feeling if you have to go and pay cash out of your wallet with everything you buy than just putting it on plastic or clicking your Apple Watch or using an auto pay service that goes to a credit card where then you get it monthly. Like, wait, how much should I spend? How did I do this? So this is where we've gotten used to credit. We've gotten used to spending. We've gotten used to low interest rates. And we've carried that into retirement. So when I did some research looking at what's called the Health and Retirement Survey, Health and Retirement Study through the University of Michigan, they look at those who are 50 and older with each successive generation. So they track people. So we can look at the World War II generation. We can go up to the baby boomers. With each generation, they're taking a higher level of debt into retirement, and less of them are paying off their houses going into retirement. It used to be you were told, when you basically retire, pay off your house because one, as you said, Paul, that's one of your biggest, if not the biggest asset in retirement. But two, think about your current budget constraints. So everyone who's listening on this call right now, think about your expenses. What are you paying out a month for food, for utilities, for your cell phone, for your cable? My guess is that the largest expense people have, or at least most people, is their mortgage or their rent. Housing is the biggest expense. What if that expense was gone in retirement? That frees up a lot of extra income, whether it's coming from Social Security or from an annuity or from your investments, to use someplace else. You minimize risk. If you carry that mortgage with you into retirement, you've got to pay it. And if you get a downturn in the market, or there's a health shock, or you get a shock in your income, do you want to get kicked out of your house? we're seeing more bankruptcies in retirement because of housing than we have previously. This is where we need to start thinking about reframing our discussion around risk mitigation retirement and not necessarily trying to have the biggest and greatest yield you can get off your assets.
Yeah, that makes a lot of sense. I mean, it's remarkable and problematic that decisions are made based on how much I can fund, how much the bank at any given point in time will let you fund, as opposed to what your utility is. Now, if your utility happens to be, in the same place, then maybe there's some other sort of reward for buying the bigger house. But, in my mind, right, you're taking on a lot of extra risk without any true incremental utility, and I think that people could put themselves could avoid a lot of issues if they thought about it that way. Because then they're forced to downsize later, and it might not be in a good market. Right. So I think this is a very good discussion for precisely those reasons.
Yeah, no, Jason, the calculation has shifted three. Let me put the step back. If I were, 66, 67, owned a house with a mortgage, the calculus has changed so dramatically over the last 2 years. Pre-pandemic, a lot of suburbs, real estate market was down. You probably had less equity in your house. Okay, but the rates were low, so you could afford to sit there. Pandemic hits, a lot of suburban areas, real estate goes way up. Okay, it also means your equity is higher. Maybe you can sell your house where you go. Now, I don't know. Like we were talking before the show. This last month, wow, interest rates are starting to spike again. Stock market, I wouldn't want to have sold my house and put it in the market last month. Not good. How do you dynamically approach something like this?
So you brought up some great points, Paul, and I think maybe the word dynamic is something to focus on. Maybe dynamic and risk are the two words we need to have as our framing here, because there are many people who, again, go into retirement without paying off their house and think, I've got income coming in from a variety of sources, including the market. If the market, and this is where I think we talked about this last time too, whether you should have the 3% rule, the 4% drawdown rule. That rule can work if you have an ever-increasing market, right? If the market keeps going up 10% a year and you're taking out 3 or 4, it probably works for you. That only works if you don't have a recession in the first 2 or 3 or 5 years of your retirement. You don't have it till the end. It's the sequence of return risk we're talking about. The same goes for housing. If people haven't paid off their housing, or they've done something even worse, like, you've heard the old joke about people taking out a home equity line of credit when they retire to buy a boat. So now they've not paid off their boat, or paid off their house, they now have a boat they've got to pay for. And the old joke is, how do you become a millionaire? First you get $1 billion, then you buy a boat. And that's how you become a millionaire. People take on this extra level of debt, and debt, I think we should really call debt risk, right? It really is risk. Are you at risk of not being able to pay it off, have an asset collected? A secure asset someone can come after, maybe you're okay with someone repossessing your car or your boat, but your house, you live in it. You need housing in retirement. And I think with the dynamic nature is what I would like for us to start having is these kitchen table conversations. You never know if you made the right decision until that decision is passed and you have hindsight, right? Hindsight is 20/20. Is the market going to go up? Is the market going to go down? Boy, I wish I would have done this. If I had bought Apple stock when it was going to $8 back when I, 20, 30 years ago, I'd be a millionaire or a billionaire, but, I didn't, so I missed out. What do we do when it comes to these discussions about dynamic nature of housing and risk? And I think people should think about is the house is an asset. If it's paid off and you go into retirement, you have minimized risk and you have expanded your flexibility. So for many people, if your house is paid off, you could use that home equity down the road for long-term care. Long-term care insurance, if you can find it now, is really, really expensive. Think about long-term care as your housing in your really, really senior years. If your house is paid off and you have to go into long-term care, you could sell your house or use a home equity or reverse mortgage to pay your long-term care and not leave that bill on your kids or your grandkids. Or, hopefully you're not going to go on Medicaid if you're indigent to go into long-term care. Thinking about planning for this and the dynamic nature of what retirement means and what the markets can do helps people think about how to better use their assets. And my fear is too often we've trained people to think about asset accumulation in their years of working. We haven't talked about the either distribution or decumulation phase in retirement and what that means for risk mitigation, and how to make sure people don't outlive their savings, they're not afraid to spend what they have, and can actually have a financially comfortable, secure retirement that they're enjoying, that they enjoy their golden years. You want to be as worry-free as possible. If you've got that mortgage sitting over your head, in turbulent times like right now, with how long is this Russian-Ukraine war going to last? Is it going to end tomorrow? Is it going to end in 3 years? Will it ever end? What does that mean for oil prices that go to $130 a barrel one day and then down to below $100 the next? Mortgage rates, again, they're now creeping upwards above 4.5%, going towards 5%. The Federal Reserve is going to start raising interest rates to start trying to tamper down on inflation. If you need to sell your house and you haven't paid off your mortgage, are you going to be underwater? Did you take out a home equity line of credit so you are underwater now? These are all really important factors to consider when talking about the dynamic nature, Paul. But I think you're right. We need to start talking about what this means for risk. And when people say, oh, don't pay off your house because you can use that money to go into the market, well, you can lose money in the market. You really don't want to lose your home.
So let me ask you this. So this is a decision that's obviously very difficult for consumers to make. Often they're going to financial advisors. Is your experience that financial advisors or the financial advice community is answering this question the way you think they ought to?
I would put it differently. It's not whether they're answering it properly, it's whether they're having the right discussion. And I think that's what's missing, right? So the answer shouldn't be, yes, you should sell, no, you shouldn't sell, you should pay off your mortgage, no, you shouldn't. It really should be a discussion with the individuals about what are their risks, what other income do they have, what other assets do they have, what are their goals, do they have a spouse, are they sick, right? There's a lot of things that go into this conversation, and it's the same sort of factors we talked about when we were thinking about when do you claim Social Security retirement benefits. It's a personal decision. One size does not fit all. The fear I have is that somebody goes into a financial professional and says, what do I do? And they just give a quick answer without having the discussion about what their needs are, what their risks are, and how they can minimize risk. And there's a difference between saying selling an asset, like selling a stock asset to pay off a house, versus taking out a reverse mortgage or another mortgage. I mean, the number of people I've seen who in the research get into their late 50s and then refinance for another 30-year mortgage is really surprising to me. The idea that you could be paying off a mortgage until your 70s or 80s is just surprising. It's not how I grew up. That's not how the framing I was brought up with. And some people are like, then maybe we're comfortable. We'll just live in the house. If we die, then someone comes and takes the house as we're dead. Who cares? That may be a smart decision for somebody who understands that and has other assets and makes sure that they have income coming in. So there's a market downturn, they're protected, and they're always paying their mortgage. For somebody else, it might not be the right decision. And they might talk about how they can use their financial assets besides the house to have a protected stream of income that also then pays off the house, so that's off their balance sheet in retirement, and it becomes a pure asset that they have flexibility with. So it's a discussion that I want to encourage, not necessarily focusing on what is the right or wrong answer, because that really does depend on the individual circumstances.
So you've mentioned reverse mortgages a few times, and we don't necessarily have a dog in that fight on the show, but it's come up. We've had Don Graves on here recently, and we've had Wade Pfau also on a couple of times, and both of them speak a lot about the role of reverse mortgages. How do you feel about them? There's two questions. One is the function of them, and the other is how they're priced. So I will. I guess let's focus on the function first, and then we can, if you have an opinion on how they're priced, we can talk about that too. But as a function, as for their utility, what are your thoughts?
So my hope in this discussion is we can talk about how the house can be used as a financial asset in retirement to mitigate risk. Mm-hmm. And then I know Wade Pfau talks about the idea of the risks you have of sequencing of market timing, and how you could use a reverse mortgage to basically get some more income later on in your retirement years. I think that's an important tool to talk about as the basket of options someone may have. And again, this goes back to my earlier discussion. I want financial professionals to be able to talk to their clients about the options that are available, what the risks and rewards are, the pros and cons, and give them a menu and walk them through it, right? No pressure, just let's talk about your options. Here's what they are. I think a reverse mortgage could be part of that discussion, but so could a home equity line of credit, right? You could do a home equity line of credit as well if you wanted to. There are a lot of structures you can do and think about how to tap into the assets of your home equity to help in retirement. But it's new at this conversation.
Well, is it wrong of me to think of taking a reverse mortgage effectively as doing what you're saying, paying off your mortgage, right? Because I think tell me if I'm wrong, if I do a reverse mortgage and I've got a mortgage, say $100,000 in the house, I think that you got to wrap the whole thing up and get rid of the mortgage, right? Is that?
Yeah. So this is, again, how do you use your house in retirement, the asset? And again, as you said, Paul, it's for most people, it is their largest asset in retirement. And, and if someone's, and again, it depends on, are you trying to leave a bequest? Do you have a spouse? What's the role? If you are let's say you're a single person, you have no kids, you have no grandkids, you're not trying to leave a bequest to somebody. Why do you want to die and leave this giant house to the state, right?
Yeah.
Or, then utilize the asset. If you got a spouse to worry about, if you're worried about wanting to leave money to your kids or your family, it's a different conversation. So again, it really is amazing how one of the reasons I love this show is we can talk about money. But I mean that sincerely. Do you know how uncomfortable it is talking money with people, like real people? They just this. They get nervous. Going back to this idea, we can have kitchen table conversations with your family members. And this is what becomes important even for people who aren't retiring yet, but whose parents might be retiring. You just sit down with them and have a discussion about what are their finances, what are their worries. Do they actually? No one likes to talk about death, but do you have a will? Do you have do you have a power of attorney? Have you structured all this? I'm starting to have friends whose parents are passing away, and they're finding that their parents didn't have the proper legal documents in order to help straighten out their affairs because they were nervous about talking about it. Or their kids now find out that they didn't have as much money as they thought, and there's debt they've got to figure out how to pay off. We need to go back to being able to have these kitchen table financial conversations in a responsible way without feeling guilty about it or nervous, so we can talk about what actually are our risks, our trade-offs, the pros and cons of various things. And that's where a financial planner comes in. That's where family and friends can come in. And we can have this, again, discussion of risk and how to minimize risk, especially in retirement.
So if I think about the problem we're really trying to help solve, right, you can step back a couple layers and say, well, it's really how do you reduce your housing expenses in retirement, right? So big component, obviously, in a debt's a hugely expensive proposition, right? There are other expenses, your upkeep. Okay, so you focus on the debt. How? Okay, I agree. I want to get rid of my mortgage. It feels like a kind of a rare solution where somebody could just go in and say, hey, Ramsey, I'm going to pull money out of my money market and pay off my mortgage, right? That feels like, Jason, what are the most likely scenarios here where I actually do eliminate my mortgage?
Here's what people start to think about. One is when you pay off your mortgage, there's a couple ways to do it, right? You just brought the idea of basically taking money from another pot. I have cash, I have a money market, I have stocks, I have bonds, I have a 401k, I'm retiring. I'm going to sell X to pay off the mortgage Y. That's one way. And that becomes a decision on risk management. It also becomes on how do you want to allocate your assets. Think about your house as a portfolio, right? The first rule of portfolio diversification is it has to be diversified. A house is part of your diversified portfolio. So you don't want to sell all of your stock assets to pay off a house, but how do you balance it? My thing has always been, I've always been concerned that people take out these home equity line of credits or keep refinancing to do cash out refinancing to buy something else. So they start looking at their house as an ATM and a cash machine as opposed to retirement asset, housing, consumption, etc. So my first advice for people when they get a mortgage is just, unless rates drop, stick with it. And if rates drop, you want to refinance, don't keep refinancing to 30 years and pushing it out. If you had a 30 year, can you get a 20 year next time? Perhaps a 15? Maybe you can do a 10 year. My first house, I couldn't afford to pay cash for my first house. I got a 30 year mortgage. Rates started dropping. I refinanced. And at some point, I was able to refinance to a 15 year mortgage. And we were talking before the show, and I'm happy to put it on in public. I am 50 years old, and I'm 2 years away from paying off my house because I've been paying it monthly and got a 15 year mortgage. I am going to pay off my house. I get letters from, banks saying, hey, you can refinance. Do you know how much equity you have in your house? I'm like, yes, that is going to be my long-term care insurance. That is going to be what my wife is going to have when I pass away. That is going to be a worry-free asset. Yeah, I've got to pay taxes on it. Yes, I'll have to have maintenance. I don't have to pay rent. I don't have to pay a mortgage. And that money that was allocated for housing can now go into other things, whether that's vacation, travel, whether I want to put that back in the market and reallocate money that was going to housing and now put it in investments. I now have that flexibility. But having the house paid off means I can start going into retirement not worrying about housing, which again, for most people, is the biggest expense. So that's when we start thinking about housing, Paul. It's not, do I sell off all my assets to pay down the house when I retire? It's, what have I got as my portfolio? Am I over leveraged in one versus the other? And don't look at your house as a cash machine in the sense of using it to buy a boat. Think about it as how you would take that house to mitigate risk in retirement and presumably down the road maybe turn it into a stream of income, which could be either, again, I'm not saying I'm buying into reverse mortgages because there's a lot of ways you could do home equity. There's a lot of things you can do. But that house, or you might decide to sell it. Maybe you get to the point where the house is too big. You bought this big house and the kids are gone, the dogs are gone. It's just you, or maybe you and a spouse in this big house and you want to downsize. What do you sell? How do you downsize? What do you use the additional proceeds for? How do you use that to? Do you buy more protected income? Do you reallocate it into the market? There's a lot of things you can do, and you have a lot more flexibility if the house is paid off or close to it.
I think part of the issue here is when a financial advisor or somebody else is having a conversation with a consumer that's kind of in that in this age range we're talking about, is to sort of express up front that it is a normal goal to go into retirement with debt free housing. Right, that is an aspirational. First, set it up as an aspirational goal, so people see it as a target. The second part of that, I think that you said that's very important is ultimately highlighting that it's an asset, and then there are things that you can do to create some liquidity around that asset. So it's the line of credit or the reverse mortgage, however you happen to do it. But the key thing is that the liquidity and resources that you draw from your house should be spent on things that are essential as opposed to things that are non-essential. I'm trying to take everything you said and sort of try to find a way to sort of frame it for people that it's okay to finance things, but if you're financing things that are non-essential, you're imparting more risk. If you're financing things that are essential or potentially essential, then you're actually reducing risk. So, anyway, this has been very helpful. I'm trying to.
This is also where I think for financial professionals to start talking to people about the role of income in retirement. Like, what does it mean, right? To basically take the wealth you have and make it into a stream of income. Whether it's a drawdown strategy or an annuity, but it's the role of income. And we do find with research and also our anecdotal experience talking to, again, real people, is that they fear running out of money and outliving their money. So they fear they're going to be living off cat food, they're going to spend down their money, they don't spend enough. And for some people, they actually die with a significant amount of assets that they could have spent, but they were just afraid to do so. And what we see, and this is research that David Blanchett, Michael Finca have done, we've got some work with the Alliance, that this called this license to spend. Right? If you have enough income coming in that's protected, it's like your budget constraints. So if you have $2,000, $3,000, $4,000, whatever the number is, that you know you're getting monthly, it's guaranteed, it's Social Security plus maybe an annuity, maybe it's a pension, but you know you've got it. You spend up to that, and you allow other money, then you can invest it, you can take it and say, I can go and be more risky in assets now because I know I've got this protected income that pays for my essentials. If that essential includes housing, whether it's rent or a mortgage, that takes up a significant dollar amount of your flexibility to do other things, mitigate risks that come. Maybe your car breaks down, maybe you need to buy a new car during COVID, which is very expensive. Maybe you have a housing repair, you get a health shock, all these things come into play. So you really need to think about what that means and then try and mitigate risk. And people don't realize that a lot of these things start happening when you retire. Again, we get older, things start breaking down, not just, our bodies start going, but we're not as young as we used to be. And who knows what's going to happen with inflation, right? Is inflation going to turn around all of a sudden go lower again? Is it going to continue to go up? Is it transitory? Is it permanent? How do we mitigate the risk and try to protect ourselves? And this is where it comes into thinking more dynamically. And the more you can reduce debt going into retirement, the better off you're going to be.
Yeah, I totally agree. You got to have somebody who's knowledgeable helping you through this. And I'll just... I had this great chat. I kind of read you a little bit of this just before the show, but I had an agent come in our online chat, and I think of the risks. Okay, the planning that's involved in doing something like this, and the amount of risk you've got to sort of dynamically work through can all kind of blow your head. So says, and I'll sort of sanitize this a little bit because we're not promoting products here, but I have in-laws that just sold their home and considering putting their profits into either one of your two annuities. Okay? All right, so they had this house. They clearly sold it, and they had to make a bet on, gee, do I keep this thing and get the appreciation? Is the market going to still going up? So they bet that probably the market's up as high as it's going to go, or they don't need, it's something they don't need. So they're going to take their profits. So they're clearly using the principal and doing something else with whatever their basis was into one of these annuities. So they're diversifying their risk, right? So they're keeping some. Who knows what they're doing? The capital gains they're thinking of putting in annuities. Now, here's what it's more complicated. I had to go dig deep on this one. Ramsey, you love this. If they submit jointly, will the policy continue as normal should one pass? Or is it better for just one to submit? Okay, so he's also managing longevity risk.
And spouse.
The spouse.
Also benefit.
Yeah.
Right? How long are they going to go? And, the answer is complicated because, if one's an owner, as it turns out, Ramsey, I didn't know this before, certain of these features disappear if the spouse is just listed as a beneficiary. So you got to think through what the contract is, who you put on as the owner. And then, Jason, the next question as we sort of dig down is, like when the money is withdrawn on a monthly basis, how's it taxed? Oh, is it free withdrawal versus income versus what does the tax rate look like 5, 6, 10 years from now?
10 years. Again, to your point, life is complicated. These are complicated decisions. And I think... Well, this is, there's a lot of things that we don't know about their circumstances, right? Do they have other assets besides the house they just sold? How much of the assets do they have? Are they getting any other income from dividends? Do they have an IRA? Taking RMDs? I don't know. So there's a lot that goes into this. But what I've started seeing, again, and part of this is in the research, you see the data, and then two is the anecdotal when we talk to real people. And you sort of merge the two together to get a picture of what's going on in retirement, is that more people are entering retirement with housing debt, so they haven't paid off their mortgage. And they've been so used to this framing of, well, I can borrow for cheap. It's almost, the phrase I always hate is, it's almost free money. There's no such thing as free. I mean,
that's the truth. Yeah.
And I don't mean that, people say free money because the cost is low, but it's the opportunity cost of that money. What you could do with it. And you have some people saying, well, take the money out of your house, in which you're paying, even if you're paying now, let's say you're paying 4%. If you're paying 4% and you can put it in the market making 10% a year and you arbitrage the taxes, you're coming out ahead, you're now financially smart. Where the market goes down, right? So you lose 20% one year in the market, you've now got this huge debt on your house that you got to pay for. You might not be able to afford it. Where it happened to your income stream. Now you're out of a house. What do? You're going to go live with your kids? You're going to, this is the risk that we're not talking about. It's too focused on trying to get maximum yield after the point of time when you should be thinking about yield. Now, I'm not saying you don't think about growth in retirement, because you got to think about inflation, but that goes back to a diversified portfolio, and the house should be part of a diversified portfolio. And also, this is where I think people get confused. They see like a stock and a bond, and they think that's an asset. So in their head, it's an asset. They look at the house, and for a lot of financial professionals, they talk about it as an asset, but it takes two functions. One is the asset, so diversify your portfolio, but you consume housing. You're living in it. So to an economist, I'm looking at this house that I sit in and I'm talking to you guys on, I'm consuming living here. So it's part investment, part consumption. And it's that consumption that we talk about with our monthly expenses we have in retirement. I have to consume utilities, I have to consume housing, I have to consume cars, I have to consume travel, I have to consume healthcare. If all of a sudden my housing consumption costs are low, I have a lot more flexibility to do and afford the other things, including shocks.
And one of which is inflation, right? So, like, if you rent, housing inflation is going to hit you more directly than if you own your home.
Yep,
so you're indexed.
Yeah, you're exactly right. And this is also, some people ask, should I rent in retirement? But yeah, the best answer we always talked about for any economic question is it depends, right? So, go back to that couple you were talking about, the advisor who emailed you, Paul. What if that couple said, we decided we want to take the next 18 months and travel? You could use, in some ways, some proceeds, have a small base, sign a 12 or 18-month lease, right? Lock in payments, have a home base, use some of those proceeds to pay for rent, go travel. and then figure out when you come back whether or not you need to have a small condo, a small house, or what you want to do. Renting's not always bad, but again, you have to understand that there's consumption, and if that's part of your budget, fine, but you're now exposing yourself to rental increases and everything else. So again, I want people to have these conversations because it's the conversations that allow the individual to say, hey, I also have this issue I didn't tell you about. Maybe add that into the conversation and see what that means for my risk.
Oh, yeah. Well, in Ramsey, you got to laugh. So you know where my head goes there is, gee, if you're going to travel and you're a senior, do you have MedSup or do you have MedAdvantage? And are you going to be a networker out? Jason, it's like you pull a thread. It just will not stop coming.
These are, again, they're complicated issues. I don't want to solve them with a bumper sticker. Rules of thumbs, are general rules that don't always apply to everybody. But it is important to have these conversations. And I think that's one of the things that is improving. We are seeing it improve. But too often, and I love that, in fact, we have access to credit. Believe me, access to credit makes things work. I mean, this is just, I'm all in favor of access to credit. I want it to be more nuanced. I want people to have a better discussion of what it means. Because it becomes too easy that people don't really understand the long-term implications of that debt. And that's whether credit card debt, housing debt, you name it. But it's part of that conversation you have to have before you go into retirement, to be honest.
So Ramsey, I don't know. Maybe your takeaways. Did we make this simpler or more complicated?
For me, the biggest thing I would hope that everybody takes away from this is, one, this idea that reducing risk in retirement is critical because you've got fewer options. Two, an important component of that is reducing or eliminating the debt that you have associated with your housing because it imparts more risk. Three, to the extent that you have a house that is an asset and you can use it to create sources of liquidity, those are sources of liquidity that should be used, one, in the case of emergencies, and two, in the case of financing your sort of essential consumption in retirement, and only, frankly, as a last resort for non-essentials. So that's sort of the framework that sort of I put together as we were walking through this.
That's a fantastic framework, Ramsey, and now we know why you get paid the big bucks. Right on the nose.
Yeah, well, Jason, this was great. I guess you've done some really good research. We have a lot of advisors listening. What would you suggest? First of all, where can they find more of what you're doing? And is there any place you'd say advisors should look to as they're helping their clients think through what they do with their mortgage?
So my research, you can Google my name, and I think you guys post links sometimes to the research.
Yes.
So I have two papers that were financed by the Social Security Administration that were done through the University of Wisconsin on debt and retirement. And that includes not just housing debt, which is the largest debt, but even credit card debt, which shows that debt levels are rising. And if someone is going to email you, we should say that it's also assets are rising, but the debt to asset ratio is also rising. So as people get more assets, they feel like they're more comfortable taking on more debt. And we see that like for 10% of the population heading into retirement at some point, they have more debt liabilities than assets to cover them. So that's also important. So that's online. Again, you can just Google my name and like home mortgage, and those two papers should come up. I would encourage people to pull up a 2-pager that the Social Security Administration does when to start receiving retirement benefits. It sort of walks through this kitchen table conversation about thinking about your spouse, other assets. That's even a good framework to have when thinking about what it means to pay off your house. Like, what other assets do you have? What other sources of income do you have? What do you want to do? How's your health? Those are important things to have a conversation with people on. And then, obviously, the Alliance for Lifetime Income, which is at protectedincome.org. We have a lot of materials for financial professionals they can use. And also for consumers. There's a dictionary, there's glossary of terms, there's things you should ask your financial professional, so we have terms online as well. And the Bipartisan Policy Center, we're doing lots of research on retirement security. Google Funding Our Future, and it will pop up to the BPC page. You can see all the work we're doing there to help people have a financially secure retirement, but also a financially secure working years. We're trying to also encourage like Secure Act 2.0 and more employers to have financial wellness programs and to encourage people to have access to and save for retirement as well.
Oh, this is great. Listen, we'll put all those links in the show notes. And Jason, thanks for having me on here again. This was
Thanks
great.
a lot.
Yeah.
Always
coming
a pleasure,
back.
gentlemen. Good to see you both.
Hey, Ramsey, thanks, and thanks to also our listeners, and be sure to tune again next week for another episode of That Annuity Show. Thanks.